You have money, or you want money, or you're terrified about money. Probably all three simultaneously right now. Here's the problem. Nobody sat you down and explained how any of this actually works. Not your parents, not your school, not your bank, especially not your bank. So you've been operating inside a system you don't understand, making decisions based on vibes, hoping it works out. Sometimes it does. Mostly, it doesn't. And the people who built the system are counting on that. Let's go. 1. What money actually is. Before we talk about finance, we need to talk about what money even is. Because you've been carrying it in your pocket your whole life, and I promise you don't actually know. Money is not wealth. Money is a claim on wealth. There's a difference. Gold in the ground is wealth. A dollar bill is a piece of paper that says someone agrees to give you something in exchange for it. That agreement, that shared delusion, is what makes money work. Here's the thing. That dollar in your wallet? It used to be backed by gold. You could theoretically show up at a bank and trade it for actual metal. The US abandoned that system in 1971. President Nixon called it temporary. It's been 54 years. The dollar is now backed by trust. Trust in the US government, trust in the US military, trust in the general consensus that this paper means something. That's called fiat currency. Fiat means by decree. The government says it has value, you agree. Everyone agrees. The system runs. The moment people stop agreeing, and this has happened many times, the currency collapses. Weimar Germany, 1923. People needed wheelbarrows of cash to buy bread. Not because bread got more expensive, because the money got worthless. That's not a history lesson. That's a warning about what happens to any fiat currency that gets abused hard enough. Moving on. 2. The time value of money. So now you understand what money is. A claim, a shared agreement. Good. Here's where it gets personal. Money today is worth more than the same money tomorrow. That sounds like financial jargon. It isn't. It's physics. A dollar right now can be invested, deployed, turned into $1.07 by next year. A dollar sitting under your mattress is a dollar slowly dying. Inflation eats it, roughly 3% per year, historically. So every year you wait, every year you don't put money to work, you're losing purchasing power without spending a single cent. This is the time value of money, and it explains almost every decision in finance. Why do banks pay you interest on savings? Because they're borrowing your money and putting it to work. They're compensating you for the time value they're extracting. Why do mortgages charge interest? Because the bank is giving you money now instead of later. You're paying for the privilege of having purchasing power earlier. Why do investors demand returns? Because they're trading present money for future money, and future money is always worth less in real terms. They want compensation for the gap. In theory, understanding this makes every financial decision logical. In reality, most people treat money as a static number. $10,000 is $10,000 wrong. $10,000 in cash sitting untouched for 20 years, with 3% annual inflation, has the purchasing power of roughly $5,500 in today's terms. You lost $4,500 by doing nothing. Congratulations. Inaction has a price tag. That's the time value of money. That's why everything in finance moves. 3. Debt, the engine nobody warned you about. So money has time value, which means borrowing it costs something, which means debt is not a moral failing. It's a tool, a powerful one, which, like most powerful tools, will absolutely destroy you if you use it wrong. Here's how debt works at the basic level. You need money now. Someone has money now. They lend it to you. You pay it back later with interest. Interest is the rent on money. That's all it is. Now here's the part they don't teach you. Debt is how most of the economy runs. Not just individuals, companies, governments, entire countries. The United States federal debt in 2025 sits north of $36 trillion. That's not a scandal. That's just how modern economies function. The real question isn't whether to use debt. It's whether the thing you buy with it generates more value than the interest you pay. Good debt. You borrow $500,000 at 6% to buy a building that earns $60,000 a year in rent. The return exceeds the cost. That's leverage working for you. Bad debt. You borrow $5,000 at 24% on a credit card to buy a TV. The TV generates zero return. The interest compounds. You pay $5,000 for a TV and end up paying $7,400 for it over 3 years. That's leverage working against you. Same tool, opposite outcome. Entirely based on what you do with it. But here's what nobody tells you about compound interest. Einstein allegedly called it the eighth wonder of the world. He may not have actually said that, but he should have. Because $10,000 invested at 8% annually becomes $21,589 in 10 years, $46,610 in 20, $100,627 in 30. You put in $10,000, you get back over $100,000. You didn't work harder, you just waited. The math did the work. The same math, running in reverse on debt, is what traps people for decades. That's not a metaphor, that's arithmetic. 4. How markets work. Money has time value. Debt is a tool. So where does all this money actually go? Into markets. And markets are not what you think they are. A stock is not a lottery ticket. It is a fractional ownership stake in a real company with real assets and real earnings. When you buy a share of Apple, you own a tiny piece of Apple. You own a sliver of their factories, their patents, their cash reserves, their future profits. The price moves up and down based on what millions of people think that future profit stream is worth, right now, today. That's called price discovery. Markets are collective estimation machines. Every transaction is a disagreement. The buyer thinks the asset is undervalued. The seller thinks it isn't. One of them is right. Nobody knows which until later. Now, a bond is different. A bond is a loan. You lend money to a company or government. They promise to pay you back with interest on a schedule. Lower risk than stocks generally, lower return generally. That trade-off, risk versus return, is the central bargain of all of investing. You cannot get high returns without accepting high risk. Anyone telling you otherwise is selling something. And here's where it gets uncomfortable. The stock market, long-term, returns about 10% per year on average. The S&P 500, 1928 to 2024, roughly 10% annually. In theory, you put money in, leave it there, retire comfortably. In practice, the market dropped 57% between 2007 and 2009. People panicked. They sold at the bottom. They locked in losses. Then the market recovered, and they missed it. The system didn't fail them, they failed themselves because they didn't understand what they owned. That's the market. Moving on. Let's talk about Nick Leeson, the man who broke a bank. 1992, Singapore. A 25-year-old trader from working-class London is given almost unlimited authority to trade derivatives for Barings Bank, the oldest merchant bank in Britain. Barings had been around since 1762. They financed the Napoleonic Wars. They helped the U.S. government with the Louisiana Purchase. 230 years of institutional history. Leeson started making unauthorized trades in the Nikkei futures market, bets on the direction of the Japanese stock index. At first, it worked. He was a star. His profits were real. His bonuses were enormous. Then a colleague made a small trading error. Rather than report it, Leeson hid the loss in a secret account called 88888. And then he kept hiding losses. And then he started making bigger trades to try to win back what he'd lost. And then he lost that too. By February 1995, Leeson had accumulated $1.4 billion in losses in a single account at a bank whose entire capital base was $900 million. He had lost more money than the bank actually had. He tried one last desperate trade, a massive long position on the Nikkei, betting it would recover after the Kobe earthquake. It didn't. The losses compounded. Leeson wrote a note that just said, "I'm sorry," and fled to Malaysia. Barings Bank collapsed in March 1995. ING, the Dutch bank, bought the entire institution for $1, £1 sterling, 230 years. Gone. Here's the moral. Leverage without accountability doesn't just hurt the person using it. It destroys the entire structure around them. Every tool in finance is neutral. The variable is always the human operating it. 5. Banking, where money gets created. So markets move capital, but where does the capital actually come from? This is the part most people have completely wrong. Banks don't take your deposits and lend them to other people. Textbook says they do. Reality says no. Banks create money when they lend. It's called fractional reserve banking. Here's how it works. You deposit $1,000. The bank is required to keep a fraction, historically around 10%, as reserves. They lend out $900 to someone else. That person deposits the $900 in a different bank. That bank lends out $810. That bank's borrower deposits $810, and so on. Your original $1,000 has become, through this chain, roughly $10,000 in total deposits circulating through the economy. Banks don't store money, they manufacture it. That's not a conspiracy, it's a feature. It's how credit expands to fund businesses, mortgages, infrastructure. The system is designed to multiply the money supply to match economic growth. The problem is when it multiplies too fast. Too much money chasing the same amount of goods. Prices rise. That's inflation. The central banks in the US, that's the Federal Reserve, tries to control this by raising or lowering interest rates. Raise rates. Borrowing gets expensive. Spending slows. Inflation cools. Lower rates. Borrowing gets cheap. Spending accelerates. Economy heats up. It sounds like a dial. In practice, it's more like steering a supertanker with a kayak paddle. The Fed got it wrong in the 1970s. Inflation hit 14.8% in 1980. Paul Volcker, Fed chair, raised rates to 20%. 20%. Caused a brutal recession, killed inflation, saved the dollar. The medicine was worse than the disease. For a while. And then it worked. That's the thing about the right call in economics. It often feels catastrophic before it feels correct. 6. Valuation. What's anything actually worth? Now you know how money is created, how it moves, how it's multiplied. So how do you actually price something? What is a company worth? Here's the thing. There is no objective answer. Value is always a model, always an estimate, always a bet on the future. The most common framework is discounted cash flow. Take all the future cash a business will generate. Discount those future dollars back to their present value. Because remember, money today is worth more than money tomorrow. Add them up. That's the intrinsic value. If the market price is below that number, theoretically, the stock is cheap. If it's above, theoretically, it's expensive. In theory, this is elegant. In practice, you're predicting cash flows 10 years from now for a company operating in a world that will look completely different in 10 years. You're guessing, formally, with a spreadsheet. You can manipulate any DCF model to produce any answer you want by adjusting your assumptions. Every investment bank knows this. They do it constantly. It's not fraud, it's finance. That's why markets aren't purely rational. People pay for stories, for momentum, for the feeling that something is going up and they'll miss it if they don't jump in. In 2000, Pets.com went public at $11 a share. An online pet food delivery company with no profits, no viable unit economics, and an inexplicable sock puppet mascot. The stock hit $14. Then reality arrived. 9 months after its IPO, Pets.com liquidated. Investors lost hundreds of millions. The company raised $82.5 million in its IPO. It had $61.8 million in losses in the same year. That's not bad luck. That's a company that spent $1.22 to generate every dollar of revenue. Valuation isn't science. It's disciplined imagination. The best investors know the difference between the price of something and the value of it. Most people don't. 7. Risk, diversification, and what you actually do with all this. So everything is uncertain. Valuations are estimates. Markets are emotional. Banks create money from nothing. What do you actually do? You manage risk. Specifically, you don't eliminate it. You can't. You distribute it. Diversification is the only free lunch in finance. That's not a motivational poster. That's a mathematical result. If you hold 30 uncorrelated assets and one collapses, your portfolio doesn't collapse. If you hold one asset and it collapses, you're done. Spreading positions across assets, geographies, and time horizons reduces the damage any single bad outcome can cause. You give up some upside. You protect your downside. That trade is almost always worth it. But here's where it gets real. All of this, money's time value, debt as leverage, market returns, diversification, only works if you start. The single most expensive financial mistake most people make is waiting. Waiting until they understand more. Waiting until the market feels safer. Waiting until they have more to invest. Meanwhile, the compounding clock is running, and it doesn't wait for you to feel ready. Someone who invests $500 a month from age 25 to 65, earning 8% annually, ends up with approximately $1.75 million. Someone who waits until 35 to start the same plan ends up with roughly $745,000. Same monthly amount, same return. 10 years of delay cost them over $1 million. Not because of bad decisions, because of no decision. Inaction is a financial choice. It just doesn't feel like one. Okay, let's zoom out. You just covered all of finance. Not all the details, a career worth of details, but the architecture, the skeleton. Here's how it connects. Money is a shared agreement with time value built in. Debt is a tool that amplifies the time value equation in either direction. Banks don't store that money. They multiply it through lending, creating a system that needs active management by central banks. Those central banks steer using interest rates, which flow through to every bond, every stock, every mortgage in the world. Markets are the mechanism that prices all of it, imperfectly, emotionally, but over time with brutal accuracy. Valuation is the discipline of estimating what's real versus what's story. Risk management is the practice of surviving long enough for the real to emerge. Every financial decision you've ever made or will ever make lives inside this system. The person who built it didn't explain it to you. That wasn't an accident. You started this video as someone operating inside a system they didn't understand. That's not an insult. That was just true 10 minutes ago. Here's the sharpest version of what you just learned. Finance doesn't reward effort. It rewards understanding compounded over time. You can work 80-hour weeks for 40 years and retire with less than someone who understood one concept, time value, and acted on it at 25. The system isn't fair. But once you understand the rules, you can use them. You just couldn't use rules you didn't know existed. That's not the system failing you. That's the system being exactly what it always was. The only variable that changed today is you. If you got value from this, hit subscribe. We break down business, finance, and economics every week. No textbooks, no jargon, no waiting. Drop a comment. What should we explain next? Thanks for watching. See you in the next one.